My name's David Hill. I was wandering around a second-hand bookshop the other day and I came across this book called The Decline and Fall of the Middle Class by a guy called Patrick Hutber. I idly flicked at it and it turned out that it was written in 1976. Coincidentally, that was the year in which I started work. I was 21 at the time. So, reading through it, I wondered if it was actually as bad as I remembered it. And I think it was. Let's have a think about the economic background at the time. In 1973, the oil price trebled, and that hit the British economy awfully. It was already going through a period of industrial strife, where the unions were demanding more wages, and it was a situation of industrial conflict with the bosses versus the unions continually almost everywhere. Strikes were continuous. They culminated in a major strike at the end of 1973, called the 3 day, which led to the 3-day week, where people were actually only allowed to work 3 days because there wasn't enough coal, because the miners had gone on strike. After that, Ted Heath, who ran the Conservative Party, decided to go for an election on who ruled the country. Well, it kind of turned out that he didn't run the country, and Labour came to power under a guy called Harold Wilson. Harold Wilson ran the country, and he had a chancellor called Dennis Healey. So by 1976, they'd introduced a period of pay restraint, and we were into phase 2 of pay restraint. And that wasn't actually resolving the economic problems. They were taxing as far as they could. So let's actually have a look at what taxes were being levied. So, first off, we have income tax. Now, if you listen to any of the tapes around the day, everything was about redistribution of wealth. It would be one sentence and then redistribution would be mentioned in the next sentence, redistribution. So it was all about trying to take money from the rich and give it to the poor. And they were going to do that largely through income tax. So the peak rate of income tax by then was set at 83% for earned income. And because unearned income wasn't the fruit of your labour, it was taxed even more highly with a 15% supercharge on top of it, making 98% the highest rate of income tax you could pay. That was called the unearned rate. So the core of it, you've got income tax, and then you've got another tax, or a tax in, not tax in name, national insurance. National insurance was levied at 5.5% on the employee, but because employers were generally seen as bad people, it was levied at 8.5% on the employer. So that was a total of 14% extra on top of the income tax that was being levied. Then, as if we hadn't got enough, we were hit with capital gains tax. And that's a banded tax with a 50% top tax rate. Now, since inflation was hovering at 15, 14, 16, 17% over this period, if you own something and you owned it 3 years later and then sold it, just through inflation the price would have risen by 40%, and then of that 40%, half would have to pay in tax to the government. Then we had corporation tax, and again there was two bands. There was 42% and 52%. And they had a very clever idea called shortfall. Clearly, if you're paying 83% in tax and you're only going to pay 42% in corporation tax, you don't want to do that. What you want to do, you don't want to pay the 83% tax, you want to pay the 42% tax. So you leave the money within your company and you don't pay the extra tax. The government was wise to that and introduced a system called shortfall, which meant that if you left the money in the company, they would tax it as if you'd paid it yourself, which was not a nice move. VAT was fairly new in 1976, and it had taken some 70,000 taxpayers who were responsible for collecting the old purchase tax into the net of VAT, and the number of people now paying was 1.3 million odd. The rates in 1976 were 8% for usual goods and 12.5% for luxury goods such as televisions, cars and the like. Then there was the really pernicious one, capital transfer tax. Forever we'd had death duties and inheritance tax, but that was abolished and a new capital transfer tax was introduced, which meant that every time you transferred capital from person A to person B, it was taxed. And obviously, because we're all about redistribution of wealth, the more money that you transferred, the more highly it should be taxed. It was banded, so you had one band up to 20,000. But by the time you got above 1 million, it was 70% of the amount transferred. Now you can see if you actually died and were wealthy in the period 76 to 84 when the tax was repealed, it was going to cost you an awful lot of money. But that wasn't all. There were import duties, and import duties by this point were governed by the EEC, who was the forerunner of the EU, and those taxes were levied at various rates, the highest ones being 13.9% on fabrics and about 12.5% on footwear. Another layer of revenue the government was trying to raise. And then, on top of that, there were even more taxes. There were rates and business rates, there was stamp duty, there was excise duty, there were licences like dog licences and car licences, and there were levies on specific industries, all of which was a heavy burden to place on anybody anywhere in the economy. The government in 1976 were taking 65% of GDP in taxes to spend themselves. Clearly that was not sustainable, and eventually, with the Tories going forward, that rate dropped, and now we're running at about 41%. So, was it bad in 76? It surely was. Thanks for watching.